Hello everyone. One of the best ways to secure your financial future is to invest, and one of the best ways to invest is over the long term. It may have been tempting of the past few years to deviate from a long-term approach and chase quick returns, but with the market's current high volatilities, it's more important than ever to focus on investing for the long haul while sticking to your game plan. Investors today have many ways to invest their money and can choose the level of risks that they're willing to take to meet their needs. You can opt for very safe options such as a certificate of deposit, or deal up the risk and the potential return with investment such as stocks, mutual funds, or ETFs. Or you can do a little of everything, diversifying so that you have a portfolio that tends to do well in almost any investment environment. Overview: Top long-term investments in August 2022. 1. Growth stocks. In the world of stock investing, growth stocks are the Ferraris. They promise high growth and, along with it, high investment returns. Growth stocks are often tech companies, but they don't have to be. They generally plow all their profits back into the business, so they really pay auto dividend, at least not until their growth slows. Growth stocks can be risky because often investors will pay a lot for the stocks relative to the company's earnings. So when a bear market or a recession arrives, the stocks can lose a lot of value very quickly. It's like their sudden popularity disappears in an instant. However, growth stocks have been some of the best performance over time. If you are going to buy individual growth stocks, you'll want to analyze the company carefully, and that can take a lot of time. And because of the volatility in growth stocks, you'll want to have a high risk tolerance or commit to holding the stocks for at least 3 to 5 years. Risk. Growth stocks are among the riskier segments of the market because investors are willing to pay a lot for them. So when talked times arrive, the stocks can plummet. Reward. That said, the world's biggest companies, the Alphabets, the Amazons, have been high growth companies, so the reward is potentially limitless if you can find the right company. 2. Stocks funds. If you are not quite up for spending the time and effort analyzing individual stocks, then a stock fund, either an ETF or a mutual fund, can be a great option. If you buy a broadly diversified fund, such as an S&P 500 index fund or a Nasdaq 100 index fund, you are going to get many high growth stocks as well as many others, but you'll have a diversified and safer set of companies than if you own just a few individual stocks. A stock fund is an excellent choice for an investor who wants to be more aggressive by using stocks but doesn't have the time or desire to make investing a full-time hobby. And by buying a stock fund, you'll get the weighted average return of all the companies in the fund. So the fund will generally be less volatile than if you had held just a few stocks. If you buy a fund that's not broadly diversified, for example, a fund based on one industry, be aware that your fund will be less diversified than one based on a broad index such as the S&P 500. So if you purchase a fund based on the automotive industry, it may have a lot of exposure to oil prices. If oil prices rise, then it is likely that many of the stocks in the fund could take a hit. Risk. A stock fund is less risky than buying individual positions and less work too, but it can still move quite a bit in any given year, perhaps losing as much as 13% or even gaining 13% in some of its more extreme years. Reward. A stock fund is going to be less work to own and follow than individual stocks, but because you own more companies, and not all of them are going to excel in any given year, your returns should be more stable. With a stock fund, you'll also have plenty of potential upside. Here are some of the best index funds. 3. Bond funds. A bond fund, either as a mutual fund or ETF, contains many bonds from a variety of issuers. Bond funds are typically categorized by the type of bond in the fund, the bond's duration, its risks, the issuer, corporate municipality of federal government, and other factors. So if you are looking for a bond fund, there is a variety of fund choices to meet your needs. When a company or government issues a bond, it is agrees to pay the bond's owner a set amount of interest annually. At the end of the bond's term, the issuer repays the principal amount of the bond, and the bond is redeemed. A bond can be one of the safer investments, and bonds become even safer as part of a fund, because a fund makes over hundreds of bond types, across many different issuers. It diversifies its holdings and lessens the impact on the portfolio of any one bond defaulting. Risk. While bonds can fluctuate, a bond fund will remain relatively stable, though it may move in response to movements in the prevailing interest rate. Bonds are considered safe relative to stocks, but not all issuers are the same. Government issuers, especially the federal government, are considered quite safe, while the risks of corporate issuers can range from slightly less to much more risky. Reward. The return on a bond or bond fund is typically much less than it would be on a stock fund, perhaps 4 to 5% annually, but less than government bonds. It is also much less risky. Dividend stocks. Where growth stocks are the sport cars of the stock world, Dividend stocks are seedings. They can achieve solid returns, but they are unlikely to speed higher as fast as growth stocks. A dividend stock is simply one that pays a dividend, a regular cash payout. Many stocks offer a dividend, but they are more typically found among older, more mature companies that have a lesser need for their cash. Dividend stocks are preferred among older investors because they produce a regular income, and the best stocks grow that dividend over time, so you can earn more than you would with the fixed payout of a bond. REITs are one popular form of dividend stock. Risk. Real dividend stocks tend to be less volatile than growth stocks. Don't assume they won't rise and fall significantly, especially if the stock market enters a rock period. However, a dividend-paying company is usually more mature and established than a growth company, and so it is generally considered safer. That said, if a dividend-paying company doesn't earn enough to pay its dividend, it will cut the payout, and its stock might plummet as a result. Reward. The big appeal of a dividend stock is the payout, and some of the companies pay 2 or 3% annually, sometimes more. But importantly, they can raise their payouts 8 or 10% per year for long periods of time. So you'll get a pay raise typically each year. The returns here can be high, but won't usually be as great as with growth stocks, and if you'd prefer to go with a dividend stock fund so that you can own a diversified set of stock, you'll find plenty available. 5. Value stocks. With the market running up so much in the last couple years, valuations on many stocks have been slashed. When that happens, many investors turn to value stocks as a way to be more defensive and still potentially earn attractive returns. Value stocks are those that are cheaper on certain valuation metrics, such as a price-earnings ratio, a measure of how much investors are paying for every dollar of earnings. Value stocks are contrasted against growth stocks, which tend to grow faster and where valuations are higher. Value stocks might be an accurate opinion on 2022 because they tend to do well when interest rates are rising, and the Federal Reserve has indicated that it could raise rates this year. Risk. Value stocks often have less downside, so if the market falls, they tend to fall less, and if the market rises, they can still rise too. Reward. Value stocks may be able to actually rise faster than other non-value stocks if the market favors them again, pushing their valuations up. So the appeal of value stocks is that you can get above average returns while taking on less risk. Many value stocks also pay dividends too, so you can get some extra return that too. Target date funds. Target date funds are a great option if you don't want to manage a portfolio yourself. These funds become more conservative as you age, so that your portfolio is safer as you approach retirement. When you need the money, these funds gradually shift your investments from more aggressive stocks to more conservative bonds as your target date nears. Target date funds are a popular choice in my workplace 401 plans. Talks you can buy them outside of these plans too. You pick your retirement year and the fund does the rest. Risk. Target date funds will have many of the same risks as stock funds or bond funds since it's really just a combination of the two. If your target date is decades away, your fund will own a higher proportion of stocks, meaning it will be more volatile at first. As your target date nears, the fund will shift towards bonds, so it will fluctuate less but also earn less. Since a target date fund gradually moves toward more bonds over time, it will typically start to underperform the stock market by a growing amount. You are sacrificing return for safety, and since bonds don't yield much these days, you have a higher risk of outliving your money. Reward. To avoid this risk, some financial advisors recommend buying a target date fund that's 5 or 10 years after when you actually plan to retire so that you'll have the extra growth from stocks. 7. Real estate. In many ways, real estate is the prototypical long-term investment. It takes a good bit of money to get started. The combinations are created and the returns often come from holding an asset for a long time and rarely of just a few years. Still, real estate was American favorite long-term investment in 2021, according to one Bankrate study. Real estate can be an attractive investment, in part because you can borrow the bank's money for most of the investment and then pay it back over time. That's especially popular as interest rates sit near attractive lows. For those who want to be their own boss, owning a property gives them that opportunity, and there are numerous tax reliefs that benefit owners of property especially. That said, while real estate is often considered a passive investment, you may have to do quite a bit of active management if you are renting the property. Risk. Anytime you are borrowing significant amounts of money, you are putting excess stress on an investment turning out well. But even if you buy real estate with all cash, you will have a lot of money tied up in one asset, and that lack of diversification can create problems if something happens to the asset, and even if you don't have a tenant for the property, you'll need to keep paying the mortgage and other maintenance costs out of your own pocket. Reward. While the risk can be high, the rewards can be quite high as well. If you've selected a good property and manage it well, you can earn many times your investments if you are willing to hold the asset over time. And if you pay off the mortgage on a property, you can enjoy greater stability and cash flow, which makes rental property an attractive option for option for older investors. Here are 10 tips for buying rental property. 8. Small cap stocks. Investors' interest in small cap stocks, the stocks of relatively small companies, can mainly be attributed to the fact that they have the potential to grow quickly or capitalize on an emerging market over time. In fact, retail giant Amazon began as a small cap stock and made investors who held onto the stock very rich indeed. Small cap stocks are often also high growth stocks, but not always. Like high growth stocks, small cap stocks tend to be riskier. Small companies are just more risky in general because they have fewer financial resources, less access to capital markets, and less power in their markets. Less brand reputation, for example. But well-run companies can do very well for investors, especially if they can contain growing and gaining scale. Like growth stocks, investors will often pay a lot for the earnings of a small cap stock, especially if it has the potential to grow or become a leading company someday. And this high price tag on a company means that small cap stocks may fall quickly during a talk spot in the market. If you are going to buy individual companies, you must be able to analyze them, and that requires time and effort, so buying small companies is not for everyone. You may also want to consider some of the best small cap ETFs. Risk. Small cap companies can be quite volatile and may fluctuate dramatically from year to year. On top of the price movement, the business is generally less established than a larger company and has fewer financial risks, so small caps are considered to have more business risk than medium and large companies. Reward. The reward for finding a successful small cap stock is immense, and you could easily find 20% annual returns or more for decisions if you are able to buy a true hidden gem such as Amazon before anyone can really see how successful it might eventually become. 9. Robo-advisor portfolio. Robo-advisors are another great alternative if you don't want to do much investing yourself and prefer to leave it all to an experienced professional. With a robo-advisor, you'll simply deposit money into the robo account and it automatically invests based on your goals, time horizon, and risk tolerance. You'll feel out some questions to arise when you start to do robo-advisor. Understand what you need from the service and then it manages the whole process. The robo-advisor with select funds, typically low-cost ETPs, and build you a portfolio. Your cost for the service. The management fee charged by the robo-advisor often around 0.35% initially, plus the cost of any funds in the account. Investment for the charge by how much you have invested with them. But funds in the robo accounts typically cost around 0.06% to 0.15% or $6 to $15 per $10,000 invested. With a robo-advisor, you can Set the account to be as aggressive or conservative as you want it to be. If you want all stocks all the time, you can go that route. If you want the account to be primarily in cash or a basic savings account, then two of the leading robo-advisors, Real Fund and Betterment, offer that option as well. But at their best, a robo-advisor can build you a broadly diversified investments portfolio that can meet your long-term needs. Risk. The risk of a robo-advisor depends a lot on your investments. If you buy a lot of stock funds because you have a high risk tolerance, you can expect more volatility than if you buy bonds or hold cash in savings account. So risk and what you own. Reward. The potential reward on a robo-advisor account also varies based on the investments and can range from very high if you own mostly stock funds to low if you hold safer assets such as cash in a savings account. A robo-advisor will often build of diversified portfolios so that you have a more stable series of initial returns, but that comes at the cost of a somewhat lower overall return. Here are the best robo-advisors right now. 10. Roth IRA. Roth IRA might be the single best retirement account around. It lets you save with after-tax money, grow your money tax-free for decades, and then withdraw it tax-free. Plus, you can pass that money on to your heirs tax-free, making it an attractive alternative to the traditional IRA. Risk. A Roth IRA is not an investment actually, but rather a wrapper around your account that gives it special tax and legal advantages. So if you have your account at one of the best brokerages for Roth IRAs, you can invest in almost anything that fits your needs. If you are risk averse and want guaranteed income without any change of loss, an IRA CD is a good option. This investment is just a CD inside an IRA, and inside a tax-friendly IRA you'll avoid taxes on the interest and accruals. As long as you stick to the plan's rules, you have almost no risk at all of the receiving your payout and your principal when the CD matures. It is about as safe an investment as exists, though you'll still have to watch out for inflation. Reward. If you want to kick it up a few notches, you can invest in stocks and stock funds and enjoy their potentially much higher returns, and do it all tax-free. Of course, you'll have to endure the higher risk that investing in stocks and stock funds presents.